Hello and welcome to the lecture on business, government, and international economy. We have been talking about inequality and we made a particular reference to Piketty's work, which is probably the most important compendium written in the century on inequality. We made a couple of statements, and the first statement is that the wealth inequality is rising, and I'll write down the wealth inequality is rising, and the second statement was the income inequality is rising. So let me write down both the statements. Wealth inequality is rising and income inequality is rising. And then he made a third statement, and the third statement was that the rise of wealth inequality is more than the rise of income inequality. Okay, so if I write that wealth inequality as something wealth inequality is more than the income inequality. So these three statements we made, and we're going to talk about this dynamics of wealth inequality, income inequality. When I say the wealth inequality is increasing or the income inequality is increasing, so what do I really mean? With respect to what? What is my baseline? Was it always the case? Is it like from the beginning of human history, the wealth inequality is increasing or the income inequality is increasing? Unfortunately for us, we really don't have data from the beginning of human history, particularly when we talk about inequality. Um, so in this case, we will kind of restrict ourselves to the study of maybe 1.5 centuries, past 1.5 centuries, and we'll see it was not the case that wealth inequality or income inequality was consistently rising. Rather, there was a time when the wealth inequality and income inequality converged, and then again it started rising. So let me actually show you some slide from Piketty's work. So this is the slide that actually explains the top decile of the wealth share back in 1900 and then again in 2010. Now in 1900 we can see the wealth inequality. Basically at that time the top decile was owning 90% of the wealth in, let's say, Britain, more than 90%. Whereas if it is in France, it was around 85%. In the United States, it was more than 75%. But look at the trend after that. So it basically, you see that there is a decline over this time, right? And then again, it started increasing post 1980s. And again, United States is somewhere close to 75%. Britain, it has declined substantially, but it is again increasing, and it is somewhere close to 53% maybe, and France it is 55%. So let me actually write down these figures on my whiteboard, so it will help us to sort of compare. So let me write down the wealth inequality, and then I'll write down the income inequality, so as we can compare these two. Wealth inequality and then I'm going to write down below income inequality. And I will take this data from Piketty's work. So the wealth inequality, let's say I write down the countries, let's say Britain, probably I could have used some other color, Stark, it's okay, France. So wealth inequality, so in 1900, write down the years 1900 and this is 2010. So what I'm going to write is basically the concentration of wealth for the top 10%, and for Britain it was 95%, as you have seen, USA is 75%, and France something around probably 85%. Whereas in 2010 this value for Britain is 53%, this value for USA is maybe 73%, and that for France is probably 55%. Okay, so that we take from Piketty's work. Now let us again go back to Piketty's work and let us actually see what about the income inequality. So if I look at the income inequality slide, we will see similarly for the top decile. So in 1900 for Europe, it gives a detail for entire Europe. It is 50%. In United States, it is between 40 to 45%. and Japan it is more than 45%. Okay, so let's just focus on United States and Europe for now. And in fact, we will see in other slides that this is the same case with India and other countries, Russia. So if I compare this, so let's say just I take United States and Europe. So United States and Europe, if I take this, let me again write down the figures on my whiteboard. So here I will write USA and Europe instead of writing Britain and France. So it will help us to have some comparison. So it is 1900, it is 2010, okay, and the value for USA is 43%. The value for Europe is 50%. I take this number from this diagram, and whereas in 2010 it is 48%, and for Europe it is 36%. Okay, now whereas this value for USA has declined, has increased a little bit, and the value for Europe has declined a little bit so far as income inequality is concerned. But if we look at the diagram, so we will see similarly, initially it was high in 1900, then it actually declined just like what you have seen for wealth inequality, and post 1980, it actually started to again increase the income inequality. But quite obviously, if we go back to our whiteboard, we will see the wealth inequality in 1900 was higher than the wealth inequality, than income inequality in 1900. Similarly, in 2010, the wealth inequality is higher than the income inequality. Now, we need to sort of answer this question, why exactly it is happening? How can we really explain this? Now, before I actually proceed, let me actually give you this idea of sort of stock and flow that we learn in our basic macroeconomics. Stock and flow. Now, wealth is a stock and income is a flow, right? So if I draw this diagram, let's say this is a bucket of water I have, and there is some input, and let's say there is a nozzle that is the output. Now, whatever I have in the bucket, that is a stock, right? That is stock, and whatever comes in, that is a flow, right? And whatever goes out, that also represents the flow. And let's say whatever we have in the bucket, that is basically the stock, and that is here our wealth. Well, so we sort of try to understand the difference between the concept of wealth and income. And this income, let's say, is coming from here, and here it is the expenses. So whatever expenses we make for our day-to-day life or any other purchases, right? Now, if I write down this wealth at time t, I can write down wealth at time t is equal to wealth at time t minus 1 plus income at time t minus expenses at time t, right? So essentially it says that whatever amount of water I had in the bucket in t minus 1 period, when I come to tth period, so I basically add the flow here and subtract the flow there, right? So basically whatever is remaining income after I make all the expenses, that is adding up to my wealth at my tth period. So that is how I get the wealth, right? And we have seen from the previous diagram, from the diagram we have seen in Piketty's slides. So we see that if I just try to plot the wealth and the income, the same trend we can see in both the cases, and that is in, let's say, it's 1900, and here I have 1980, and here I have 210. And here for the income also, I will have the same timeline. And if I plot it, what I'm going to see is this. Let's say this is the coordinate. This is the coordinate here. And what I'm going to see, and if I have, let's say, this is the line. So essentially the inequality was high, and then it declined, and then it started rising. Similarly for income, it was high, it declined, and it's rising. So how do I explain these two phenomena, along with the fact that the wealth inequality is more than the income inequality? Now, it means from this stock and flow diagram, it means we can actually say that people are saving more. Okay, so basically I can make a statement that people are saving more. So basically over a period of time, whatever expenses they're making, so that is actually less than the income, or probably the gap between income and expenses is increasing, and that is why the net wealth is increasing. So that's a good news actually. If you end up saving a lot of money, you can invest that money in the economy, and you can have more capital stock. And we have learned from Harold Domar growth model that it's good to have a good capital stock, but because that actually um, you know uh, leads to a good economic growth rate, right? Now, people are saving more, so that's very good news. But the fact is, inequality is increasing. So that means not everyone is saving more. Okay, some people are saving more. Okay, not everyone is saving more. So some people. So I will just modify the first statement in the second statement. So I will just write some people. Some people are saving more. Some people are saving more. Okay. So that is where the inequality part is coming in. Now we need to explain who are these people who are saving more and who are these people who are not saving more. So these two statements we need to actually sort of investigate. Right? People are saving more, and it's not all the people, but some people are saving more. Now, to explain that, let me actually um, sort of summarize this inequality in two sentences. One, the income or the wealth inequality is increasing, that we have seen among the different groups. Okay, among the different groups. So basically, so that among the different deciles, we can see top deciles are earning more than the bottom deciles. Okay, so income, wealth, inequality is increasing among different groups. Among different groups. Now the second statement is, which I'm going to make, and which is a new statement, and that is the gap between returns to capital and returns to labor is increasing. So first statement we have already seen, but the second statement is something new that we are making, is increasing. So what we are trying to say here? What I'm trying to say is, if I have among the some people, the people who owns the capital are actually able to save more because the returns to capital is higher, or actually the returns to capital vis-a-vis returns to labor, the gap is actually increasing. So people who are just using their labor to have their earning, they are actually sort of able to save less, whereas the people who are using capital for their earnings, they are actually able to save more. Okay, so these two statements I'm making. So I'm just going to explain these two statements in detail, but in this lecture we'll end this discussion on why exactly some people are saving more. So I claim that people who have access to capital, they are actually able to save more. Okay, and people who just use the labor for their earning and saving, they're unable to save that much. So we'll in the next lecture we're actually going to elaborate these two statements. Thank you.